In this week's video, we'll review the latest charts to help us answer the question, is the stock market facing an insurmountable wall of resistance? To help us answer that question, we'll be updating numerous bull-bear roadmaps that we've covered in recent weeks and months, and in several cases, we'll expand on the original analysis and present new findings. This is the area of potential resistance that we covered on short takes this week. Clients and regular viewers may remember that we covered the possibility of the market forming an inverse head and shoulders pattern, which is a bullish pattern, back on January 25th of this year using an SPY chart. If this turns out to be a left shoulder, it's noteworthy that the S&P 500 and SPY moved above and below the red 200-day moving average numerous times. Thus far, the S&P 500 has held above the red 200-day. And if we flip to a high-low close chart as of Friday's close, you can see this area that we identified back on January 25th thus far has acted as resistance. You can see price went up to the blue line and was rejected earlier in the week. In terms of assessing probabilities relative to what could happen next, in the remainder of the video, we'll review numerous charts and studies. Before we take a look at the markets on Friday, March 1st, one of the common themes in our bull-bear roadmaps that we've been covering in recent weeks was price action around the 200-day moving average can be telling. In many of the bullish cases that we've covered in recent weeks, the S&P 500 was able to clear and hold above the 200-day moving average, in this case shown in orange. In many of the bearish or retest cases, the S&P 500 was unable to rise and hold above the 200-day moving average, in this case shown in red. This is the look of the moving average cluster chart that we covered back on January 25th. We said we would learn something either way. If we look at the same chart as of Friday, March 1st, we can see thus far the S&P 500 has cleared all of the moving averages in the cluster and is holding above the orange 200-day. And it continues to distance itself from a probability perspective relative to many of the unfavorable outcome cases that we've covered in recent weeks. And it's extremely important to keep in mind, these are not just lines on a page. Market action, and mainly price, speak to the psychology of market participants, their prior concerns, and their present-day interpretation of all the known information, including the fundamentals. Taking that into consideration, there is a reason why institutions are selling near the 200-day moving average here. When the market is rising, they're assessing the big picture, looking at all the data, and many of them make the decision on the way up here that they're going to reassess near the 200-day moving average. And if they don't see what they want to see from a fundamental and technical perspective, they're going to sell. Similar situation here. This is a reflection of the assessment of the fundamentals of the day and all of the known information at this point. Just as the ability to clear and thus far hold above the moving average cluster, and especially the orange 200-day, is a reflection of the present-day net aggregate opinion of all market participants regarding all subjects on all time frames. We can basically say the same thing for the 200-week chart that we covered back in early January of this year. There's a reason why buyers are stepping in near the 200-week moving average here, here, and here. Many of them have made a decision that it's not as bad as the market is reflecting here. And when we get to a key bull-bear guidepost, such as the 200-week moving average, many of them act based on their interpretation of the fundamentals of the day. The whole concept of using these bull-bear roadmaps was to help us differentiate between the bullish cases and the bearish cases. This market action here speaks to psychology and an interpretation of the fundamentals. This rejection at the 200-day moving average here speaks to market psychology and the interpretation of the fundamentals. Just as price action in recent weeks speaks to the interpretation of all known information as of March 1st. That's extremely important. The charts cannot predict the future. Therefore, it's possible something changes in the news cycle and we lose this look here, but that hasn't happened yet. As the S&P 500 has moved in this direction and blown through all types of potential resistance, the present-day facts have become less and less aligned with the unfavorable cases that we've been covering in recent weeks. And that statement is based on the known information today. This is observable evidence that we can see on February 15th. We had relatively weak trend strength scores here, but we can look ahead and see how the data most likely will react in the weeks ahead. And at this point here, and in this area here, the trend strength model is not the model. It's one of the major components of the model. And we also knew that we had the extremely rare breadth thrust that we covered back on January 21st. This is also not just a technical phenomenon. You have to think through what the breadth thrust means. A breadth thrust is basically a conviction imbalance. We had a 10-day period where advancing issues relative to declining issues had an extremely high ratio of roughly 2-to-1. That's very, very rare. And how does that happen? It's not because there are more buyers than sellers. There's a buyer and seller in every single transaction that takes place in the financial markets. It speaks to an abrupt shift in conviction. The advancing issues relative to the declining issues comes from spreads in an imbalance that basically causes an abnormally large percentage of issues to rise. What does that tell us? It tells us the market's fundamental concerns in here, the magnitude of those concerns shifts significantly here. Something that the market was very, very worried about here has changed here. One excellent example, the Federal Reserve. So this imbalance, this is hard evidence that we have in hand, tells us to keep an open mind about this market's profile improving. And relative to the look on January 25th, when we knew about the breadth thrust, if we fast forward to March 1st, it has indeed improved, just as the trend strength model has improved significantly, and the readings in the model have improved significantly, and hence why we've been scaling in an incremental fashion. One of the key characteristics of these bullish cases was the fact that for the most part, when the market tried to make a run at the 200-day moving average, in many of the cases, it was able to clear it on the first attempt and then consolidate above it. Clear it on the first attempt and consolidate above it. And even in the cases where it wasn't the first attempt, it's still a relatively convincing push above with some consolidation on the other side. A convincing push above with consolidation taking place well above this point here. And this is consolidation that lasted several weeks. So far, the present day chart looks more like something like this or this relative to the four looks here. And that statement is based on the known information that we have in hand today. We'll continue to take it day by day with maximum flexibility. Let's take a moment to update this analysis, which you may remember from a probability perspective, told us that when the 100-day moving average crosses below the 200-day moving average, it's very, very rare to get a V bottom that blows back through to the other side with no retracement. We studied all of the historical cases that were similar, and somewhere in the neighborhood of 80 to 95% of them had some type of retracement, meaning we did not get a V bottom in the vast majority of these cases. And we conducted that analysis based on the known information that we had in hand several weeks ago. If we fast forward, the look of this chart has also changed. If we're expecting a retracement or bearish outcomes, we really don't expect the market to blow right through the 100-day moving average and the 200-day moving average. So the known information that we had in hand earlier this week was we had 11 consecutive S&P 500 closes above the 200-day moving average, and that occurred after the 100-day moving average dropped below the 200-day moving average. And this move from here to here reflects a shift in the market's perception of the fundamentals of the day relative to the market's perception on the left side of this chart. Therefore, we wanted to know, if we looked at these historical cases here, what happened in these cases when the market eventually morphed into a look like this? If we zoom in on the present day, Wednesday of this week, we had the 11th consecutive close above the 200-day moving average. Eventually, in 1953, the same thing happens. This is the 11th consecutive trading day with a close above the 200-day moving average. The same can be said for all of the charts on the screen, with one exception. This case, we get the 11th consecutive close above the 200-day just before the 100 crosses below. In the 1969 case, we get the 11 closes above the 200-day almost simultaneously with this cross. We're scrolling through all of the cases that are similar to the look here on February 27th, 2019. So in all of these cases, this is our 11th consecutive close, 11th close, etc. And as a reminder, we're looking at these 21 cases here that we covered in recent weeks. 1984 up to 1994. And the last 5 cases are shown on the screen here, including 2010. Thus, it might be helpful to know in the present day what happened next in the other 21 cases after the 11th consecutive close above the 200-day moving average, following a cross where the 100 dropped below the 200. So we flip these 21 cases and analyze them now based on the known information that we have in hand today. And in these 21 cases, roughly 1 year out, the median gain for the S&P 500 from this hypothetical point here historically was roughly 11%, with 71% of those 21 cases posting positive returns. From a similar look historically here, 90% of the 21 cases were higher in roughly 3 years, and the median gain from this hypothetical, for illustrative purposes only, point here relative to the historical cases was almost 38%. So earlier this week, we had 11 consecutive closes above the 200-day. In this case, in 2002, the setup failed. There's a lot of red here. And this is where the common sense comes in. If market participants The net aggregate opinion of all market participants is bullish, and good things are going to happen. Most likely, we're going to stay above the 200-day moving average. If the net aggregate opinion of all market participants is bearish, we're going to have trouble holding the 200-day moving average, which is exactly what happened in this case. It only held above it for 13 trading days and then it failed. In this case, it was 14 trading days and then it failed miserably. And in this case, it was 15 trading days. In the 1973 case, this is the 11th day above the 200-day, but is going to fail in 3 trading days. Therefore, the longer we can stay above the 200-day, the easier it is to distance ourselves from this case in 1973, this case in 2002 that failed, and the first attempt at a rally off the low in 2015 that failed after 15 trading days above the 200-day moving average. And why did these cases fail? They failed because something changed in the news cycle or the interpretation of the knowns here produced a net aggregate opinion that was bearish. This is an example of how trend following works. Common sense tells us the longer we can hold above the 200-day moving average, the better it's probably going to be for returns. And conversely, the longer we hold below the 200-day moving average, the lower the probability that we're going to produce favorable returns. So in the 2019 case, if the S&P 500 can hold above the 200-day moving average through Wednesday's close of next week, that would be 16 closes above the 200-day, and theoretically, we would be distancing ourselves from the failure outcomes. And that passes the common sense test. The more this looks like a bullish case, the lower the probability we're going to get an unfavorable case. And the numbers get even better if we can remove these cases. The same logic applies to these cases that produced either mixed or unfavorable outcomes. We've held above for 11 days, which was the count when we did the original analysis earlier this week. Friday's close is the 13th trading day. Therefore, in the present day, if we can hold above the 200-day moving average for 22 more trading days, from a probability perspective, we start to distance ourselves from this case and this case, which again passes the common sense test. And if we can discount these cases based on the facts that we have in hand 22 trading days from today, the probabilities improve even more because the present day is looking less and less like the unfavorable cases. This is very, very similar to the analogy that we used on Twitter. Common sense tells us when we're getting ready to leave the house, the darker the clouds, the higher the probability we're going to take an umbrella. And the clearer the skies, the lower the probability we're going to take an umbrella. In 2019, if the skies are still clear and things are improving, we can continue to scale in and leave our umbrella at home. If it turns out to be like the 1973 case, where this look here, after 11 trading days above the 200-day, fails and starts to move in this direction and we drop below the 200-day, then that hard data will be reflected in our decision-making process and our allocations. And again, you might say, this is common sense. Yes, that's why it makes sense to use this. It passes the common sense test. Also passes the economic common sense test. There are fundamental reasons why the market fails at the 200-day here, here, and here. Just as there are fundamental reasons that the market successfully clears the orange 200-day here, 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 and here. So as the data improves and the skies become clearer, Let's take a harder look at how that can impact the theoretical probabilities. And to do that, we can compare this summary portion of the table with all 21 cases, with these 3 cases removed, and then with all 5 of these cases removed, which is exactly what we have on our screen here. This is all of the cases. These are the odds based on what we know today. The odds would improve if skies are still clear as of next Wednesday's close. And the odds would improve even further if skies are still clear 22 trading days from Friday's close. Here's an example. With all 21 cases, the median return over the next 90 days is 2.36%, with 57% of the cases posting positive returns. If we can eliminate 3 of those cases, 2.36% goes to 4%, and a 57% win rate jumps to 67%. All 21 cases looking out 360 days, roughly an 11% return. If we can hold the 200-day and still have sunny skies and blue skies as of next Wednesday's close, theoretically, we can eliminate 3 cases. 360 days out, we go from roughly a 10.9% median return to a 14% median return. And our positive outcome or win rate jumps from 71% with the 21 historical cases up to 78% if we can eliminate 3 of the unfavorable cases with the hard data next Wednesday. And that's to be determined. And it works both ways. If we can't eliminate these cases and price drops back below the 200-day moving average, it tells us that we have to respect that really ugly things could still happen from a historical perspective. Hence, our present-day allocations are based on the facts that we have in hand today, not what we anticipate may or may not happen by next Wednesday or 20-some-odd trading days into the future. We're not forecasting, we're making decisions based on the facts in hand. If we can eliminate the 5 worst cases, 22 trading days into the future, 90 days out, the median return goes from 2.3% to almost 5%, and over the same period, a win rate of 57% historically, relative to a jump all the way to 75%. Looking out 540 calendar days, or roughly 18 months, our median return with all 21 cases goes from 18% up to over 27%, and our win rate goes from 81% historically up to 94%. Remember last week we covered the rare monthly Bollinger Band cases, and 2 of them also had somewhat of a turbo boost because they overlapped and also had that extremely rare breath thrust. And since that analysis was done with monthly charts, and we looked at the chart as of month-end January, we can learn a little bit more now that February is in the books. We're still holding above the center line, and we said in that analysis our concerns would increase if we got a monthly close below the center line, just as our concerns would increase the longer the S&P 500 would stay below the 200-day in the present day if it can't hold it. We also have a higher monthly close relative to this high here. And remember last week we said in the 1954 case, which ended up producing very favorable outcomes, even in that case, sideways consolidation for several weeks occurred. This is sideways consolidation from roughly December 1st into mid-January of the next year, telling us that even if good things happen in the present day, it's possible that we could get some sideways consolidation because the market needs to consolidate its gains off of the V low. That's all to be determined. But the improvement in the weight of the evidence and the evidence that we're covering in this week's video also speaks to the probability of eventually clearing this resistance here. The 1991 case was our second historical turbo boost case, and you can see we confidently moved and stayed above the orange 200-day moving average. And since 2019 is the third turbo boost case, extremely rare, you can see the outcomes here align with much of the data that we've covered in recent weeks and some of the data that we'll cover in this video, which is favorable returns from the setup with relatively shallow drawdowns. 2019 case to be determined. This table here tells us that returns following the rare breath thrusts were very, very favorable. And 2 weeks ago, we looked at the maximum drawdown that occurred 35 days after the breath thrust. And in 2019, the breath thrust was completed on January 8th. And the results basically said the average and median drawdown was extremely shallow. And there were a handful of cases that told us to keep an open mind about a much larger magnitude give back. Since this analysis was completed 2 weeks ago and the market has moved, and in the historical cases, the market moved as well, we knew that this table here that was based on February 12th was starting to get a little long in the tooth. So we updated it as of February 27th of this year, helping us understand the odds of what a drawdown might look like hypothetically in the present day based on these past historical cases. And as you might imagine, the results didn't change very much, and they're still extremely favorable from a probability perspective. And they still tell us it's not prudent to throw all caution to the wind from a drawdown perspective. Let's review the case here on the bottom of the screen. Since 15 to 30% drops in the stock market are relatively rare, we wanted to know, dating back to 1950, if we look for S&P 500 cases that featured a 15 to 30% drop, followed by a push back above the 200-day, how did the market perform after closing above the 200-day for 9 consecutive sessions? It's 9 sessions because this was done a few days ago. And as you may have seen on short takes, and common sense tells us, if we've had a huge plunge and give back in the market, and the market is able to retake the 200-day moving average and hold above it, the probability of good things happening, we would think, would tend to increase. And that's exactly what happened historically. After the big drop, in the handful of historical cases that meet this criteria going back to 1950, really no ugly performance looking out 1 year, and very satisfying returns from a historical perspective, with one case posting roughly flat performance looking out 24 months. So how about the drawdowns in these cases here? In terms of normal market activity, in these historical cases, the drawdowns were very, very shallow. Looking out 1 year, worst case was a give back from this setup here. So in one case, the market dropped 5.3% from this day, which would be following a 15 to 30% drop after the market closed above the 200-day moving average for 9 consecutive sessions. The biggest drawdown from that point to the lowest low over the next 360 days in these historical cases was 5.3%. The median drawdown was less than 1%, and this is the maximum drawdown, and the average drawdown was roughly 1%. We know 2019 will follow its own path. This just helps us assess probabilities based on the handful of similar cases dating back to 1950. We continue to make excellent progress on the bird strike project. As many of you know, the Los Angeles Rams had a great year on offense, but ended up scoring the fewest points in Super Bowl history. The Rams coach after the disappointing game. How can we use these cases as learning opportunities to make sure that if these things do come up in the future, we're putting our players in a position where they're better ready to execute on the fly and adjust? That's exactly what the Bird Strike Project is about. As we've shown numerous times over the last several weeks and months, you really can't find any historical case in history where if really good things happen for a long period of time, the data doesn't eventually turn and improve. It's just the way the math works with trends. And the readings in our model have improved significantly over the past 2 to 3 weeks. And as of Friday's close, we are allocated exactly in line with the weight of the evidence. From an expectation perspective, the system's relatively simple. You keep and add to the positions that are working, and you reduce and or eliminate positions that are not working particularly well. The probability of us keeping every position in our portfolio at this point over the next 12 months is very low. There's going to be winners and losers. From an expectation perspective, if the S&P 500 can clear this area of potential resistance, whether it happens next week or in several weeks, we would expect, based on where the model is today, that we would be reducing any remaining cash that we have at a much, much faster rate from here. But as always, we'll continue to take it day by day, and all of that is to be determined. If we want to execute properly, we have to head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.